Hello and welcome to today's tutorial brought to you from To The Tick on a very specialized flag known as the high and tight. Now, technical analysis and traders' experience has shown flags to be price patterns that happen a lot. They're very reliable and they're really pretty easy to see. They're seen usually in both bullish and bearish conditions, and that's the first consideration that we have to have for this flag, is that the high and tight flag is only seen in a very bullish base of support. So to start, I'm going to let the machine actually draw for us and start drawing the pattern here of what would be considered an absolute ideal, classic, picture-perfect image, which of course doesn't always happen in the real world. But flags in general, we know they happen in impulsive phases of market structure. Breakouts certainly qualify for an impulsive phase of a market structure. So we have a pole to our flag. That's part one. We must have the pole. Part two is that we have the pause or consolidation period in that impulsive move, and that part gives us the actual flag. And then as traders, we look for what might be coming next. So we get to see the pole, we get to see the consolidation or flag, and then as traders, we're looking for that follow through or what might come next to actually create what we would call a bullish continuation pattern. Now, this particular flag, the high and tight, I told you it was a specialized flag, but all flags really do offer us pretty clear objectives for the further move or the what happens next type of concept. This flag certainly does also, but this one also offers us parameters very clear on what to use for stop placement as well. We have very clear characteristics for what we want to see out of the pole. So again, it has special conditions, so it doesn't happen as often as some of the other flags, but it has a very high percentage on being a very high performing price pattern when you get a chance to see one, and it does take a very strong bullish build of support to create it. So you have a certain characteristics to be looking for before you even want to try to be looking for the pattern. So let's go on and do as traders do and look at it as bar by bar and see if we can actually find a trade as a bullish continuation pattern. Now you'll notice I don't have any prices, I don't have any kind of an instrument. We're not actually looking at a chart, but we're representing price action, and we're looking for the bulls to have built this big base of support underneath down here, and it's just they've been hammering their head on that orange line, which will represent resistance, and we want to see them finally get enough juice and enough gumption to get themselves through that price point of resistance. And when they do, we want to see them work their way back and prove that they're going to hold that breakout, not a false breakout, but a real breakout, and then we want to see them charge. And the thing about this trade is we want to see the bulls really snorting, really pushing, really causing a lot of drama and a great big exhaustive gain. Now, for every trader, whatever you're trading, the definition of this gain needs to be unusually large surge in volume and in price. I'll say it again. The pole that creates the high and tight flag needs to be unusually large in both volume and price, hence the name high. Okay, now we're going to look at the consolidation phase or the flag phase. And again, flags, we like for them to be nice and shaped very rectangularly. But this one, I'm telling you, probably won't remain a real tight rectangular structure. But you still use your upper resistance level based off the tip of the pole. And the highest price is reached in the swing high. The pole's bottom, or where it's planted here in this bullish base, is the swing low in prices before the run started, up to the swing top in prices. Then you look for your first bar pull down and you draw your horizontal or not quite horizontal line. The point is, as I said, this specialized flag says if it's going to truly be a high and tight, we're not going to allow any more retrace in the price action than 30 to 35%. Maximum allowance for your retrace, 30 to 35%, and that number is based on the full length of your pole, swing low to swing high. Now, we also are looking as traders at this point in time, because we've already got the pole established, we've already got the swing low to swing high. Now we look for where our measured move might give us our target. So we're going to take the measured move at 50% of the entire distance of that pole and add it to what we'd be looking for as a new breakout line, which would be current in the immediate picture, current resistance. So we're going to take 50% and add it right here, and that's going to be our next target. Now, during the period of consolidation, the pause, we don't want them to spend a whole lot of time here. The entire point to this trade and to this picture that you're looking at is that the bulls have been very firmly in control, and they're not giving anything back. They have gained ground, and they're not going to give it back. They've been relentless in how they get here, and they're not going to let you have much of a pullback. So 30 to 35% is max. So those of you more interested in being aggressive, knowing that you don't want this pause to take very long, you're watching the volume hit its head on the upper resistance in the immediate picture, watching the bulls supporting on the blue line. You wait for a swing or two on that type of an effort, and you're watching them consolidate down here in volume. You're watching the bulls maybe add a few more little extra juices every time they buy in. So as an aggressive trader, you're welcome to work this backside picture on the blue line as long as you respect the 30 to 35% rule on the pullback. Get that to it, through it, and action through that line, and then prove that you can hold it as support, and use that same breakout looking for that big surge in volume again to accompany a big breakout. You get a surge in volume, and then maybe they think about it a little retrace back into the action. Fine, just be prepared and realize that on every one of these new tops that you're working on, you're liable to get a test. Let them come in and get their supply, and then you're looking for that follow-through target that we already laid out. Now, there are two places where this exact same picture of the flag that we started with might not be so beautiful. I wouldn't be doing you right if I didn't show you what those were. So again, the exact same picture that I had drawn from slide 1. And now, again, the flag is about, are we going to continue this bullish continuation move? It's already happened. We've seen the pole and we've seen the flag. So if we're looking for what comes next, why would we need to be wary? Well, if the background is showing a great big breakdown out of a level into a steep, steep drop, and then it comes bouncing down into this lower level of support, okay, trade the bounce. Trade that multiple picture there and trade that bounce. Get that velocity, volume move. But will it be a continuation pattern of that move from right here? Or will your top line, remember your target, you're looking for them to break that line, and you're going to target a breakout here and add 50% of the pole to go where? Right into resistance up there again. So again, be wary. I'm not saying it won't work, but this should be a bullish setup. And while this is a bullish move to create the pole, will it be a bullish move coming out of the flag based on your background? So scenario number 2 is almost the flip side. For scenario number 2 has the bulls charging from underneath, from a much lower level of support, and through a line of resistance that they haven't been to yet. and they go charging through that line of resistance with yet another big volume and price surge, meaning your pole, another big volume price surge. Gosh, don't we need a pause? So again, is the likelihood that they might need to come back down here somewhere a little further than your 30% rule and come back here and retest to prove that that first effort on that big resistance might need to get a little more support. So two scenarios, again, to be cautious. Now, the high and tight flag in summation is considered a bullish continuation pattern. The bullish pole is the most important characteristic of the pattern. You want a dramatic surge in volume and in price. Cannot be said enough. That is what establishes this pattern. Without that big, unusually large gain, you are not looking at a high and tight flag, period. Now, part two, the consolidation offers little pullback in price. The price action's merely a pause, and it feels that way, and there's no real restriction on this shape, even though most flags, we look for them to be somewhat rectangular, and all that really means is give me a line in the sand of resistance, give me a line in the sand of support, and then show me where I might be getting that breakout. You're looking for those target measured moves using that pole, and you're going to work that 30 to 35% line in the sand on the backside, and the pole tip establishes your 50% move for your potential. And if you get to that breakout tip and you get to it and you get through it and you hold it, then you have your high and tight flag, and you'd be looking for the continuation of this bullish pattern. So thank you very much. This ends the tutorial on the high and tight flag brought to you from To The Tick, and we hope that you visit our website. Bye for now.